In this video we are going to talk about Indian dividend stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Dividend stocks are equities in firms that pay out dividends on a regular basis. Shareholders who own dividend stocks typically own shares in well-established corporations that have a track record of redistributing earnings to shareholders. A dividend can be defined as a financial compensation that publicly traded firms give to their shareholders on a regular basis. Dividends are paid out of the net profits of the company. Such incentives can take the shape of cash equivalents, stock options, or other forms of compensation, and they are often paid out of the remaining portion of profit after all necessary expenses have been fulfilled. Companies, on the other hand, may choose to keep their accumulated profits in order to reinvest them back into the firm or to set them aside for future use. Here are some of Indian best dividend stocks. Number 1. Bajaj Auto. Bajaj Auto is a two-wheeler company that has established a solid reputation through time. What distinguishes Bajaj Auto from other two-wheeler manufacturers in India is the company's unwavering commitment to expanding its international reach. By not being overly reliant on any one geography or product, the corporation has been able to de-risk its business operations. Bajaj Auto is the world's fourth largest three- and two-wheeler manufacturer, according to industry estimates. The firm is by far the largest exporter of motorcycles and three-wheelers from India. Overall, the company's total exports surpassed 2 million units for the third consecutive year in fiscal year 21. It also continues to dominate the three-wheeler segment, where it is the market leader, according to the company. The company's expansion and presence in both the domestic and international markets has been fueled by the success of its own brands as well as its partnership with KTM Motorcycles. Bajaj has lately joined the electric two-wheeler industry with the introduction of the legendary Chetak, which has the potential to be a growth catalyst in the long run. The government has maintained its support for the adoption of electric cars in India and has boosted the demand incentive for electric two-wheelers in its amended FAME 2 plan, which is expected to benefit Bajaj Auto in the near future. Over the last 5 years, the company's revenues have increased at a compound annual growth rate (CAGR) of 4.21%, while its profit after tax has expanded at a compound annual growth rate (CAGR) of 3.62%. The company has excellent return ratios, with a return on capital employed (ROCE) of 25.4% and a return on equity (ROE) of 19.8%. Number 2. Gale. Gale holds a strong position in the natural gas transmission business, with a market share of around 78%, which is facilitated by its extensive pipeline network, which spans 13,772 kilometers. The construction of pipelines necessitates huge financial investments as well as negotiating a complex regulatory environment. From 58.10 million tons in 2018, natural gas consumption is expected to grow at a compound annual growth rate (CAGR) of 4.18% to 143.08 million tons by 2040, resulting in the government implementing many actions to boost the percentage of natural gas in the total energy mix. The demand for natural gas is likely to continue strong in the coming years, driven mostly by the city gas distribution (CGD) system and the fertilizer industry. Gale has also expanded its operations into downstream industries, such as the production of petrochemicals and liquefied petroleum gas (LPG). In order to sustain strong segmental contribution, the natural gas marketing and petrochemicals business of Gale has been contributing to its profitability. Furthermore, the recent jump in crude oil prices, as well as the high spot LNG prices, are projected to result in significant revenue increases for the corporation. Healthy profitability and good cash accruals result in favorable debt metrics and a favorable capital structure for Gale, which makes the company's financial risk profile attractive. Over the last 5 years, the company's revenue and profits have increased at rates of 1.97% and 26.7% compound annual growth rate, respectively. The debt-to-equity ratio is low, at 0.13, indicating that the company is still in good shape. Number 3. Hindustan Zinc. A total capacity of 1.2 MPa is available from mined metal, and the company also has smelter capacities of 43,000 TPA in the zinc and lead industries and 600 TPA in the silver industry. Internationally, it ranks second among zinc lead miner and smelter companies and fourth among zinc lead smelters. It holds a commanding position in the domestic zinc market, with a market share of approximately 78% based on volume. The high entry hurdles to this industry, such as capital-intensive operations and a scarcity of zinc ore mines, give the company a major competitive advantage in terms of risk profile. The company's presence in international markets further increases the variety of its revenue streams. Following the temporary impact of the lockdown, which occurred in April 2020, the company saw a considerable increase in its production. The company's mined metal production reached a record high of 972,000 metric tons (MT) in fiscal year 21. With its own zinc supply, it was able to meet 80% of the demand for zinc in the domestic market. In addition to having a significant net worth and a substantial liquid surplus, the company has no long-term debt, which helps to mitigate its financial risk. As of March 31, 2021, the total amount of cash and cash equivalents was Rs.15, 130 crore. Vedanta Resources' dividend payouts, on the other hand, are typically substantial in order to service its debt obligations. With a dividend payment ratio of 113% in fiscal year 2020, the corporation generates a dividend yield of 6.27% in fiscal year 21. Hindustan Zinc, on the other hand, is subject to cyclicality in the galvanized steel industry. A significant portion of India's zinc production is consumed by the galvanized steel industry, which accounts for around 70% of the country's zinc production. Zinc is also up against competition from replacements for galvanized steel, such as aluminium and other alloys of steel. Since the zinc and lead businesses account for more than 75% of the company's total revenue and profitability, the corporation confronts a significant concentration risk in its business profile. Number 4. SJVN. A micro-Ratna firm supported by the Government of India, with a 59.92% stake, and the Government of HP, with a 26.85% stake, SJVN has the remaining stake held by the general public. SJVN aspires to be a 5,000 megawatt MW firm by 2023, a 12,000 megawatt MW company by 2030, and a 25,000 megawatt MW company by 2020. Other hydro projects in SJVN's portfolio are currently in the survey and investigation, DPR preparation, and feasibility study stages, with others in the pipeline. The company's largest project, the 500 MW Nathpa Jhakri Hydroelectric Power Project, HPP, has been in operation for 15 years. SJVN operates on a cost-plus tariff framework for both operational and under-construction projects, which assures the recovery of set charges for debt servicing while also generating regulated returns on the investment made. With a dividend payment ratio of 52.2% for the fiscal year ending in 2021, SJVN is a good investment. Currently, the corporation offers a dividend yield of 7.42% on its shares. For the past 5 years, the company has maintained a strong dividend track record, declaring dividends on a continuous basis. In the short term, SJVN shareholders may not have anything to be concerned about in terms of dividend payments due to the company's solid net cash position. With a large amount of under-construction capacity, 3,301 MW, SJVN is exposed to a significant amount of project execution risk, completion within budgeted time and cost estimates. Number 5. Itc Ltd. Itc Ltd, formerly known as the Imperial Tobacco Company, began as a cigarette manufacturing company, producing brands such as Gold Flake, Flake, and Classic under its own label. Education and stationery products, hospitality, paperboards and packaging are just a few of the areas in which the company has expanded. Purchasing Sunrise Foods Private Ltd is likely to increase its market position in the spices area, while also increasing its product range even further. An established distribution network, a well-known brand, and a strong research and development capability. have helped the company to consolidate its position as the market leader in the Indian cigarette market, according to the company. In spite of the increase in tariffs, cigarette smokers have demonstrated significant brand loyalty, as evidenced by the company's continuous market dominance and profitability over the years. The financial risk profile has been strengthened as a result of a healthy internal cash accrual, low debt, and strong liquidity. ITC has a 35.1% operating margin, which is above the industry average. The corporation has no debt, while having a substantial tangible net worth of more than Rs. 899 crore. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.